Hey, everybody. Welcome back to Empower Women in Insurance podcast. My name is Teresa Kitchens, your host, and we're talking today to Colby Allen with AgencyFocus. And we are in a little bit of a series. We're talking about finances. We're talking about how to be able to run a healthy business financially, right? So today, what we're going to be talking about a little bit more is we're going to talk about ownership. We're going to be talking about equity. We're going to be talking about balance sheets. We're going to be talking about all these different things that might be dirty words, right? To some of us mentally, they might be things that have a little bit of an emotional charge to them. So we're going to start today talking about these things, because these are the things that as owners and as people who are maybe even just in leadership, if you are a co-owner, if you are maybe an agency manager, or maybe, all these things really would be things that would really, really benefit you to know a little bit more about how these things really operate and the importance of them to an agency. So we're talking to Colby Allen today with AgencyFocus. So Colby, welcome back to the podcast.
Thank you. Thank you for having me back. And usually when I say from Louisiana, it's hot, and today in my office space it's freezing. So if you see me
Oh
shivering, that's
no,
why.
you're
But
not used to that, right? I mean, you're
no,
you're probably a little bit out of your element today.
we're warm-blooded. But thank you for having me back on, and I'm really excited to dive into this. One
Yeah.
of my favorite topics is actually financial statements. So talking about
Wow.
agency ownership and a lot of things is it's huge. I'm that guy. I don't know if you went to college, probably. What did you study in college?
My undergrad is elementary education.
Okay. For a lot of people that went to school for business, usually you have to
Yep.
take like Finance 101,
Yep.
and financial statements is part of that class where you get a big thick ass textbook, and there's sections on what's a P&L statement, which we talked
Yep.
about last time, what's a balance sheet. And so you're, as a student, looking at these things like, how am I ever going to use this? Just like we did in algebra, right? I'm never going to use this in
Never
my
gonna
my
use it.
real life.
Right.
But I will be the first example to say that I do actually use those things on a daily basis. Even
Exactly.
algebra. It's funny. Even algebra.
Exactly. Even
Um,
algebra. I love it. I love
So
it.
all
So
that to say, a lot of people took, finance in college, and you see financial statements and see what they are, but it's not until you become an owner or a business owner that those things become a very real part of what you do.
yeah.
And even then, it's a very small portion of the time that you spend in managing your business. And so,
But it's so core to being able to run a healthy business. And um, I think one of the things that I struggled with, we kind of covered this in the last podcast, is that I went through a period of ownership where I just kind of stuck my head in the sand and I just wanted to breathe and I just wanted to live. Right. And I was like, oh, I don't care what the IRS wants for me. I don't care what profit and loss is. I don't care what's on my thing, and I had to get to the point where I was ready to have the conversation about what's healthy. What do I need to do? How can I look at this and know what I am? And I found that by knowing those things, it has helped me to, whenever my anxiety gets a little bit out of control, or if I wonder if I need to hire somebody, if I need, do I have the bandwidth to be able to do that? What can I afford? What can I not afford? By knowing my numbers, it helps take away so much anxiety
yep.
for what I can and cannot do for my team, what I can and cannot do for my family. Um, everybody knows that I'm 50, and my husband's a little older than me. He's turning 65 this year, so he's 14 and a half years, or about 14 years older than me, because I turned 51 this year. So it's one of those things where, as we look at life changing, right? So it's not just that my life is going to change because he's going to retire, but it's also the conversation that our lives are going to change, right? Our financial lives are going to change. And so therefore, with that, we had the whole conversation a couple weeks ago. Um, okay, so what does this mean? Where are we going to do? What are we going to have? What are we not going to have? Because without looking at those numbers, it was just this huge anxious thing, right? About insurance, about health insurance, and all this other stuff. It was also about, what are the finances, and based on our goals for what we want in his retirement and what we want to be able to accomplish. But we had to come down because we were having all these urethral pie in the sky conversations, right?
Yep.
Like, we want
Yep.
to go here, we want to go to Italy, we want to travel, we want to do this, we want to do that. Well, then, okay, if he's going to retire, then he's like, oh, but if I retire, we can't do all that. I go, well, then what have you been like preparing for the last 40 years,
Exactly.
And
Why you've been working.
he's like, yeah, but that's, my husband's one of those who loves a good savings account, right? And so, the idea of his savings account going down 50 cents is very scary to him. And I totally get that. I totally get it. But we are transitioning from one mentality to
Yeah.
another. And I know that even in businesses, whenever we hire people, we have to transition from one mentality to another. If we want to be able to bring on investments, like there's a lot of agency owners that buy their building, right, or buy a building, you know.
Yep.
If we want to be able to transition to where we can travel more and not be as much of the day to day, maybe we want to be able to focus more on, like we talked about in the last episode, maybe like community involvement, or maybe we would just want to transition professionally. We've got to know our numbers
Yep.
in order to be able to be free to be able to make those transitions. So it's not just the really big transitions like selling or even acquiring or all those. It's also, like I mentioned, hiring, firing. Are we willing to grow? Where are we going to invest? Am I going to pick up the CE for my team members? Are we going to, what are our bonuses going to be this year? What are we going to reward our team with? If we don't know our numbers, we don't know what we can do.
No. Or you might make decisions and find yourself in trouble
Yeah,
because you didn't really plan for it. And so
true.
there's other stuff that comes up. If you don't look at it closely, it can be a big impact.
Yeah.
I actually didn't plan on talking about this, but I'll go ahead and throw this out there because it's so prevalent and it's so hard to see. But a lot of owners don't know their numbers. And so if you operate on assumptions, you know what they say whenever you assume.
Yep.
You make an ass out of you and me, right? So it's
Yep.
like if you don't know your numbers, how do you know where you stand and what you do? It's not uncommon for an agency owner to have certain assumptions about the value of their agency and not make other plans accordingly. So the fact that you're telling me that you and your husband have intentional conversations of retirement, likely have 401k or other assets or things that are going to
Hmm.
support that, that's huge, huge. One of the things that perpetuates, people joke, right? Or they make fun of agency owners that are working in their late 70s, early 80s.
Right.
It's often because they can't retire.
Mm.
Because if you don't really know your numbers, right, or set up a system that you can actually reasonably do that based on how you want to do it, and then you actually wake up one day and say, you know what, I'm ready to sell the agency, I'm ready to retire, and then find out that even if you sold the agency, you probably couldn't retire.
Hmm.
That's a big wake up call.
It is.
And the hard part is, the value of your agency is not like just going to Yahoo Finance and typing in a stock ticker and seeing
Yeah.
what the market rate is, right?
Yep. You can't go to Kelly Blue Book for your agency and figure out what the market versus the resale value versus the whatever salvage
Right.
value, whatever of your agency is. I mean, there's not this, nobody wants a salvage value. That's not my point. But
No.
I mean, there's not just like one online place where you go on in, you put in the condition of your agency and how many miles you have on your agency. And, you can't do all that. There's so many different elements that go into it.
So we'll say side tangent. There actually is a website that tracks an index of a captive agency that you can sell your book that they give you factors. I don't promote it, but there is
Wow.
a
Okay.
marketplace that does that. We don't do that for independent agencies, but yes, you can, however, do evaluation on a routine basis to get an
Uh-huh.
understanding of where you are and what your goals are, and is the agency value tracking with what you need, or do you need to look at other assets or other
Yep.
things that you can invest into? And so that's kind of a side tangent, but I think it's a little bit relevant. But one of the
Very
things that
relevant.
we want to dive into too is like the balance sheet. And one thing that's
Mm.
different from a lot of agencies that makes agencies different from a lot of other businesses. And so insurance agencies operate on what are called intangible assets.
Yep.
Okay. You sell policies that hold a financial value, that have a lifetime value of renewal or recurrence into the future. And so it's an intangible asset, though. You can't physically grab a policy. You can print it on paper and you can hold it, but the actual value of that policy is not on the paper.
Yep.
It's on, if that client has a claim, the insurance company is going to deliver on their promise or the language of that contract, right? And either indemnify them, make them whole, whatever that looks like. And then as an agent, you get to share in the transaction of that through a commission. Okay.
Right.
And so the money coming in essentially is based on something that you can't actually touch or feel or do something physically with, versus say a retail store, you have physical inventory.
Yeah. Well,
And
there's also
so
that conversation of something to come repossessed, like a bank. Like if you default on a loan, right, and you are a manufacturer of something, so you have big, I don't know, woodworking machines, right? They can come back and they can repossess that, right? But an
yep.
insurance policy is not something they can come in and repossess.
No. Yeah. A bank can put certain liens and then also the loan will show up on your balance sheet, right?
Right.
And be reflected in your retained earnings and your owner equity. But for the most part, you're right. Like they can't repossess, right, insurance policies.
Right.
And so the way that, say, an agency or a service-based business is different from, say, a retail store or another product-based business is the value of a product-based business is going to be found on the balance sheet in many cases. You've got
Right.
inventory that goes through a process. You can sell it and turn that for a profit. An agency, however, is you've got cash, right, to run your operating expenses and your payroll and those types of things. You probably have some liabilities in short-term payables or maybe a loan that's due or other things. You can have some assets in the agency name, like you mentioned, owning a building
Yep.
or maybe owning a vehicle, right? Those types of things. But the real value of the agency is going to be found oftentimes in the profit and loss statement,
Mm.
in the renewal and the recurring value of those policies. However, a balance sheet is still critically important for a couple reasons. I'll just throw this out there and shots fired.
Yeah,
Some
of course.
some agencies, when they record, say, the revenue, right, to their company, actually try or do to record premium as revenue or income, and then will count premium paid as cost of goods sold, which gets to your net commission. However, if you do your statement like that, it gets very confusing to
Yeah.
say like, okay, I've got a $5 million book of business, right? So I've got $5 million coming in. I've got $4.5 million going out. And then at the end of the day, when I get down to my profit, I might have, say, $100,000 in profit.
Right.
Well, if you divide $100,000 into 5 million, that's not a lot of profit.
Oh,
So organizing your statements to where you're actually recognizing your commission and fee income as income. And then what does need to be timely used for a lot of agencies as it is relevant is your premium coming in and premium going out will actually be more reflected in your balance sheet.
okay.
So your accounts receivables, right, maybe your premium coming in, your accounts payables due to your companies will be your premium going out.
Right.
The net effect of that is going to be shown up in your actual income on your profit and loss statement. And so, not uncommon. I've seen this
Right.
several times where if they don't actually work with a good accounting firm to keep good, clean statements, I have actually seen some people have like a trust account, right? That'll show up. And if they don't actually keep track of that money coming in and going out, and those accounts get out of balance, on paper, it can actually look like you owe a lot of premium to your companies if you're not really accounting for that well. Why is this relevant?
Mhm.
So even though the bulk of the value of an agency is going to be based on your EBITDA and a multiple that's applied to that, the tangible net worth of the agency is something that's very important because you still, as an owner, have access to the cash. You might have the building, right? You've got other things in there. Or if you've got loans that are payable, right? Those things need to be accounted for timely
Yep.
and easily so that when you actually do go to sell or do plan the equity value that you have, you can account for either those asset or liability values because they are going to be adjusted and reflected whenever you actually change ownership.
Yep.
And so hypothetically, people try to leverage debt to build value, but if you're not actually growing and using those things to drive growth that's relevant, you still owe that money. That's a liability. And you need to figure out, okay, well, the agency's market value is X for the book of business. But if I still owe Y on this loan, right, that's something I need to really take into account.
Yeah.
And then, I mean, the accounting equation, your assets equal your liability plus equity. Okay. So I won't get too nerdy, but your asset value, right, is going to be reflected on how your assets are what the agency owns.
Okay.
The liabilities are what the agency owes to third parties or vendors. And then your equity is what the agency owes to its owners.
Okay. Okay.
And so the reason you start an agency, the reason you start a company is to, one, build up a good income for yourself, or two, build an equity value that you can actually use for, like we talked about in the last episode, goals that you want to
Yep.
accomplish, whether that be
Absolutely.
distributions and taking out profit, whether that be investing into your team, investing into education, right? Having retained earnings or cash you can actually do those things is critically important. So keeping good, clean statements allows you to know how much cash is in the bank so that you can make those decisions timely and appropriately and not put yourself in some other danger.
So, Colby, as we talk about a balance sheet, right? I really want to nut down to what that really truly means because we're talking about ownership, equity. We're talking about, revenue minus, your liabilities minus this, that, or the other. So when we're talking about a balance sheet, are you really just talking about what we spend our money on, like money in, money out, right? I mean, isn't that pretty much the core about the concept of a balance sheet? Money in, money out. But then I know you're also talking about liabilities, and you're talking about owner equity, and you're talking about all this. So if just for those people, including myself, who are not in that range, because we talk about a profit and loss statement. I think sometimes if we go to QuickBooks, right, we go to our P&L, right, we think, oh, that's your, in my mind, that's my operating, that's my in and my out, right? So tell me a little bit about what you're speaking of as far as making sure that we're really nutting down to the balance sheet conversation.
Sure. So the two kind of key statements for any business, you have your profit and loss statement, which like you summarized, money in, money out. Okay.
Right.
In terms of your operations, the balance sheet, the reason it's a little bit different is one, a profit and loss statement is going to give you a summary of your operations at a given period of time, whether it's for the month or for the year, quarter, whatever the time frame you measure. A balance sheet doesn't give you more of a snapshot of the financial position of the company as a whole
Okay.
based on whatever the valuation date is. And so if you look at your balance sheet for, say, the end of December for 23, that'll give you a snapshot in that time of how much cash you got in your bank accounts, how much of other assets that you have from a book value, what money do you owe other people or vendors, and then the equation of those two things actually tells you as an owner how much is actually available to you to do with whatever your discretion is. So the reason it's a little different is because I think I mentioned in the last episode, there are some cash activities that can affect the business that don't show up in a profit and loss statement.
Okay.
However, a balance sheet does take into account other decisions made by the owner that would then be shown on a balance sheet. The key difference is, right, if say you've got your basic salary as an owner, but you take out distributions or owner draw, right?
Okay.
Once a month, once a quarter, whatever. Your draw is not going to show up on a profit and loss statement, but it does show up on a balance sheet.
Okay.
So what the balance sheet does is it summarizes again what assets, what the agency owns, the liabilities, what the agency owes, and then the equity is what the agency owes to its owners. And
Okay.
so the reason you do that is because, like, another thing that doesn't show up is, say, loan payments.
Oh,
Loan
okay.
payments are considered a financing activity, not an operations activity. And so it can show up for tax purposes in a couple different ways, but the actual loan payment actually may not show up in your profit and loss statement, but the balance of that loan is going to show up on your balance sheet.
Okay.
Yeah.
Okay.
So the two kind of purposes, right? Your profit and loss gives you a snapshot of your operations. Again, the money coming in, money coming out from a core operational standpoint. The balance sheet for you as an owner ultimately kind of tells you, okay, what's your actual financial position in the company?
Okay.
So if you're making profit, that's going to show up in your net income or your retained earnings. If you're not making profit, that's going to show up in your net income or retained earnings. If you owe money to, say, a bank for a loan, right, that's going to show up there. It gives you, again, just a whole overall health picture of the agency's financial position. Um, the other thing that's, again, really important is if you don't keep those things accurate and timely, I'll give you an example, right? We just did an evaluation recently, and the agency didn't really have an up-to-date balance sheet. But when we started digging into it, they actually owed a lot of money on a loan that they used to purchase the agency. And
Okay.
so if they're planning for an exit in the next 2, 3 years, right? That's something you kind of have to plan for.
Yep.
Because you can look at the
Well, because
biggest,
that loan has to be paid off, right?
yeah,
And it's not the purchaser's responsibility to be able to pay that off. It's mine, because I'm the one who took out the loan to be able to do whatever it was that I was doing, right? Like if I was buying another book, or if I bought a building or whatever, I'd still have to pay off that loan. I mean, they can finance it on their end for the purchase valuation that I pay off or I get out of that money, but that doesn't mean that's money in my pocket,
right,
because I got to
right.
go pay off that liability.
Exactly. And that's a key distinction too, because a lot of people very quickly know and think the reason you form, say, an LLC or a corporation is to separate your personal assets from your business decisions, right? A legal shelter or a legal wall. What a lot of people don't really think of is if you're the shareholder, you actually have fiduciary responsibility to the company for one, yes, you get to benefit in the gains, but also you take on the liabilities of the company as a shareholder. And so if there's a net profit, you can share in that profit or use that profit for your goals or your purposes, like we talked about in the last episode. If there is a net loss or a deficit, and
You make up
the
for it.
business needs more money. That either has to come from you or you have
Yep.
to find other financing means. And so it's people think about the benefits, right? They start a business looking at the benefit and the upside, but it does also include some risk. And keeping a healthy balance sheet, right? An up-to-date balance sheet helps you know whether you're in the black or you're in the red and you have like risks that you're trying to manage from a cash flow standpoint, from an ownership standpoint. And so for owner equity planning, we said this last time and you say it quite often, right? But business is not a sprint, it's a marathon.
Yeah.
And so using your balance sheet in addition to your profit and loss statement helps you have that snapshot on a month-to-month basis to see, okay, what's the financial health of the company just in general? And how do I use that for my goals? And so part of our CFO service is we actually measure and look at using your P&L every month, but also your balance sheet every month and look at how we're managing cash. How are we making investments? How are we actually planning those things to drive and get to the goals that we're trying to achieve?
I like it. I like it. And again, we kind of talked about this in the last episode. It takes a lot of what's really what I'm looking for? A lot of humility and a lot of focus to be able to have those conversations, because looking at some of those numbers can be tough, right?
Yep.
It might mean that we need to cut back in certain areas. Maybe we don't need to spend so much in certain areas. It might mean that we may need to spend more in certain areas, right?
Yep.
And it may mean that we need to reallocate money into areas that mean more or that matter more for based on, what our goals are for the business. So I love the fact of looking at the operations as well as the balance sheet as well as that whole process, because it's not just about the ins and the outs. It's also about what are you really working with? What are your liabilities? What are you doing? Because I know a lot of people think that we are prepared to make a certain change in our business or our careers, and then when we get in there, all of a sudden it's like, nope, that's not going to happen, right? And
Yep.
that becomes very, very challenging.
It is. And here's another maybe call back to what we said last time, right? Whenever you had your conversation with Carrie and she said, no, you're doing good, like you're doing fine, right?
Yeah, yeah,
That
yeah. I'll
sigh
never
of
forget it. I was
relief
like, oh, it was like
and
my whole like body just went, oh, I'm so excited.
that
It
weight
was
off
like
your
such a
shoulders.
relief. Yes, it was. It weighed off my
Yep.
shoulders. Exactly.
And so what we do and help owners to use those things for is financial ratios, right? It's a
Hmm.
KPI or a key performance indicator, but there are ways to measure KPIs from your balance sheet and your profit and loss statement that are a very quick indicator of, hey, you're doing good, right?
Yeah,
You're doing okay, right? You don't have anything to majorly worry about. However, if this gets to, say, this point, okay,
yeah,
we need to look at it closer, right?
right.
And so that's why we keep good statements month to month so that we can know and track, okay, what's our performance? What's our trend? Are we trending in a positive direction or are we going in a risky direction? We need to make some adjustments.
Mm,
I mean, a real example, right? Some agencies that have really good revenues, but if they're running very thin margins or they have a very high debt service, your decisions you can make are much different than if you didn't have that debt.
yep.
And so keeping a real time picture on, again, what you owe to your creditors as a short term or a long term liability, what the impact is to, how that affects your operations. Because here's the thing, you can make adjustments on discretionary expenses, right? You can change software, you can move to a new location that's cheaper. Like you can make decisions like that. You can't necessarily call your bank and say, hey, I'm not going to pay my note for 3 months while I
Right.
get while I
Wouldn't
get
that be
this other
nice?
thing
Yeah,
straight,
and,
right?
and I'm not gonna like go into cancellation. I'm not gonna have fees. I'm not gonna have all sorts of problems, right? Yeah, I'm just not gonna pay you for 3 months. It's fine. It's not a big deal.
Right, right. So
We don't like that.
managing your cash flow and managing the health from, knowing what's as an owner, the things you're responsible for is crucial. And so,
Yeah.
yeah, again, people talk about agency ownership. They talk about, having equity and growing something that's going to be valuable for you or your family or whatever your plans are. But very few people really dive into what are the actual risk of owning a company and how do you use your financial resources to keep track of those things. So again, you're not a financial, guru. That's okay, right? I've got an MBA in finance, so that's why you hire us, right?
Yep.
Because we can take those things and distill what can be complex or more nuanced, things to measure and align those very easily to things that are important and valuable to you so that you can make those decisions a lot easier.
Mm, yeah.
And also call back to like what you said and things we talked about was that, money's very personal. And so whenever you have to kind of pull back the curtain and look at those things, it can it can be embarrassing and shameful for a lot of people to say, okay, I've gotten here. How do I redirect it? How do I remanage this?
Yeah.
it's not uncommon for some agency owners to come to us if, say, they made an acquisition that probably didn't have good diligence, and say the retention wasn't as good as they thought it was going to be, or they made a really high offer and in some cases overpaid.
Yeah.
And so now they're super tight on how they actually, manage the cash to afford that note.
Yeah.
And so, knowing how to value something and how to actually look at it from a planning standpoint, it's not something that everybody's an expert at, right?
Right.
Even I know some people that have degrees in finance and still, have to go back and watch YouTube videos to actually figure out how to read these statements, right?
Right.
um, and so, we do this on a routine basis, but it's our job. That's what we do professionally.
Well, and I think insurance is different too. I mean, because like I have a bookkeeper, and my bookkeeper is very good, but they don't specifically run in the insurance realm. So I mean,
Sure.
like just the whole premiums account, the escrow account is
Yep.
like it just really blows their mind, and I don't understand why it blows their mind. And I'm not gonna say I'll be there forever, but at the same point, that's just where I'm at. But I mean, it's always amazing to me the conversations I have to have on a repetitive basis because they just don't understand the dynamics of the insurance space, right? Or, some of that. So having somebody on your side, not only that knows the balance sheet, knows the P&L, the equity conversation, the liabilities, all of those things, but then also can take that and translate that into the conversation of your premiums account and what to be able to expect, and be able to look at the real numbers that are associated with an insurance agency. Because an insurance agency, I'm not gonna say it's super unique, but it is in a lot of ways. Like we
Mhm.
talked about earlier, you don't have that brick and mortar. A lot of times, I mean, that you own a lot of times, and a lot of times you don't have like equipment in your office beyond computers. That computers and desks and chairs are great, but they don't usually constitute a huge buyout or a huge equity, or they don't really like. There's not a lot of resale value for somebody who gives you a loan, right? Like there's not a
Yep.
whole lot of recovery value. I guess that's kind of where I'm going for, say, a
Yep.
bank. So I think we really have to know what these are, because as an insurance, I know even as an agency owner, there are only certain banks you can go to. You can't go to Wells Fargo and get a bank to be a loan to be able to go buy another agency. They're not going to do generally a loan, but you can go to a couple of other ones, right? Because they understand and they have different underwriting guidelines for what they're willing to lend and how that's willing to go. So I think we have to know what these dynamics are in order to be able to make sure that we grow not only appropriately, but just that we can grow. I
Yeah.
mean, just so that we can exist in a
Also,
good way.
no, this is actually a really good point. So, I will say there are few banks that specialize in working with agencies.
Right. Okay.
That doesn't mean other banks won't do it, because I know some community banks and I've worked with some others that they know agencies really well, even though they don't do it on a daily basis. And I actually saw a stat recently that of the major banks that are familiar with industries, I want to say insurance agencies was like one of the top five classes of business for the SBA loan program in the country.
Oh, wow.
Yes. So it's huge, right? A lot of agencies use financing for a lot of different things. And
Yeah.
so whether that's acquisition, whether that's financing other parts of growth, right? And so managing debt is huge. And working with a bank or a financing partner that actually knows those things, that can read your statements, the statements that are clean, right, and available for
Yep.
them to use, is critically important. And so it's something that I think a lot of owners, like I said, don't pay attention to in working with an accounting firm or a bookkeeper that actually knows, because kind of like to my example with the P&L statement, if on paper you're recognizing premium as revenue and then premium out as cost of goods sold, and looks like you got 5 million in revenue
Yep.
and only $100,000 in profit, you know, that's not a lot. And actually on paper, that's like, well, what are you doing with all this money?
Right.
Versus if you actually kept clean statements of actual commission and fee income of $500,000 and then getting down to your $100,000, which shows a 20% profit margin, that's a different conversation.
Yeah.
And so, um, the ways that, and I guess we can kind of transition to like some of how managing your cash and managing your actual expenses gets down to what your actual equity value is. And so we kind of touched on this last time, but agencies are valued, right? Not necessarily on a balance sheet,
Hmm.
but on an EBITDA, pro forma EBITDA, that you were able to reasonably show that the agency can maintain, on a given financial year. And so again, not like a product or physical product based business that you're going to actually have tangible assets of inventory and those types of things. but insurance agencies are intangible. And so there has to be a way to measure the risk of that intangible asset over a period of time.
Right.
Calculating an EBITDA from your profit and loss statement is critically important. We also touched on the last time about how, not to really try to muddle, your actual operating expenses and discretionary expenses. There needs to be a way to cleanly show, okay, yes, on paper, I'm making 5% profit, but really, if you actually look at the core operating expenses, we can make a 30% profit margin, right? Or a 30%
Right.
EBITDA. And so that's what a bank is looking for is, if a new owner steps in, what's the reasonable profitability of this agency? So accounting for a manager's salary, right, or that person being paid a fair wage, what money is actually available to service debt
Mm.
if you use debt to actually buy the agency. And so the risk profile that they apply to that, again, we try to calculate a pro forma EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization.
Okay.
Why do we use that number? That's because we drill down to what are those, again, owner discretionary decisions. And so your interest expense is going to be based on financing decisions that you make, right? If you
Right.
run your company expenses on a credit card and you kind of keep a balance, you're going to pay interest. If you've got a loan, you're going to pay interest on that, right? But the financing decisions are usually owner decisions for
Right.
certain things that you're doing.
Yep.
Taxes, another owner decision, right? We kind of already gave the example. Uncle Sam, people don't like him. And so
Right.
they're gonna do whatever they can to not give him anything. And so the ultimate tax burden of the agency is going to be based on decisions that you make as an owner.
Yep.
And then depreciation and amortization are non-cash expenses that are recognized on your profit and loss statement for tax purposes.
Okay.
So as you buy computers, right? You said computers, or
Mm-hmm.
if you buy a building or do upgrades on your building, you can depreciate physical or tangible assets for tax purposes.
Right.
What's common for a lot of agencies too, if you buy a book of business, amortization is an intangible asset because you bought the goodwill of the book of business that you purchased. Again, you're not buying physical policies, you're buying the essentially a guarantee or a goodwill value that you're going to have that revenue in the future.
Right.
For tax purposes, it's actually treated the same way as like a patent or a license is for a
Okay.
product. It's an intangible asset that has some type of value. So even though you're not physically buying something, for tax reasons, you can deduct that over a period of time based on, what the terms are.
Okay.
So all that to circle back to depreciation and amortization may not be actual cash expenses that are coming out of the agency at that time, but you made a very significant investment and the IRS allows you to deduct a portion of that for tax reasons.
Nice.
So all of those kind of encompass owner decisions for very big purchases for the company.
Mm-hmm.
So EBITDA, in a way, is a measure of the profitability available to the company with a non-biased owner, right? That's just stepping in and just going to manage things normally. Okay.
Right.
So the reason banks use that to underwrite a loan for an agency is because, once the actual liabilities and things are adjusted through a transaction, that's typically going to be the cash available or the money available to fund a debt service,
Okay. That makes sense.
right? And so because the other owner, they're going to have to clear their own loan, right? Or they're going to have to clear their other liabilities. And so that money in a way kind of gets reset or reorganized to be able to be allocated to other types of owner decisions.
Right.
And so EBITDA multiples, people have all types of wild expectations and assumptions on what those are. And so oftentimes you see the headlines of very public and publicized transactions of agencies selling for, 10, 12, 15 times EBITDA.
Right.
Actually today, right, there was a PR release that Truist Insurance Holdings is selling to a private equity fund. So the bank is selling the agency portion of their company to a private equity fund. And in the article, it says that it is estimated that it's 18 times actual core EBITDA of the company.
Oh, wow.
So what does that mean? As an investor, the private equity fund is assuming or buying essentially 18 years of future cash flow as an investment. Okay.
18 years. Wow.
18 years.
That feels
So
like a
these are,
lot. Like as an agency owner, I sit back and go, 18 years. That's like a lot.
So that's a question. And oftentimes through the evaluation process of asking owners, when we look at the reason we do evaluation is to assess a risk profile of the agency to see, okay, well, in this range of normal, what are the strengths and things that are positives and synergies or things that are good about your agency that would reduce the risk and allow them to invest in more cash flow? Or what are the things that are more risky or a weakness or problematic that cause more risk for an investor? And
Mm,
that's how we kind of
yeah.
figure out a range of a multiple that a reasonable investor would make in the future of this agency. And so some of the biggest drivers are growth. And the reason that growth is given a premium value factor is because as the agency grows, the relative profit or the relative EBITDA also increases. Versus if you have an agency that's completely flat, they're not growing. Would you as an investor, here's a hypothetical question. So, um, comparable analysis, if you look at public agency stocks, Gallagher, Brown and Brown, Aon, you
Right.
can look at the multiples of the stock price compared
Hmm.
to what the adjusted EBITDA is for the company. Typically, those fall between, say, 13 and 15, pretty close in that range. That's why you hear a lot of times when a private equity agency or a big buyer comes in, they'll pay between 12 and 15 because that's what a public company trades for. Is a family small town agency, right, doing the same things from a risk profile as maybe one of those bigger agencies?
No, they're going to be very, very different.
Very different. And so the reason we go through evaluation process is to see, okay, well, compared to what is best practice and publicly available data, how does your agency compare from a risk profile to that?
Right.
And so I mentioned earlier, we'll get a little nerdy, right? Okay. So the most common multiples that are applied to EBITDA for private transactions
Right.
for banks are usually between 6 and 8. And
Okay.
so you calculate a pro forma EBITDA, and then typically the range is going to be if it's higher risk, that's going to be a little bit lower. If it's going to be lower risk, then you kind of qualify on the higher end.
Okay.
Between 6 and 8 is the most common because if you use traditional retention rates, most banks are going to underwrite a loan to what we usually look at as 75% of the EBITDA that's available to that agency from a cash flow standpoint. So basically, they're not going to give you 100% of the EBITDA that's available because that's very risky from a loan standpoint, right? At that point, if you're not
Yeah.
growing, if you shrink at all, you're going to be strict for cash
Yeah.
and
You're
you're
not
not
going to
going to be
have it.
able to
Yeah.
afford your payment. So that gives you a little bit of wiggle room. Starting at 75%, assuming a 90 to 92% retention rate, almost right at the 7-year mark, actually gets to where that same level of EBITDA, if you manage your expenses well, is almost exactly to be 95 to 100% of what the original EBITDA was. So even if a new owner
Wow.
makes some mistakes, right?
Yep.
You don't have retention perfect. You don't do any upselling. You don't grow that book of business. In most cases, you can still afford that note between 6 and 8 years out.
Okay.
Okay. Ideally, you want to grow it,
Yeah. Ideally. Yeah.
which
But
is
there are,
why,
but I mean, but I think we all know that there is still going to be some attrition, right? I mean, we
yep,
have to make sure that we understand. Ideally, we do all want to grow, but there are people that are like super, like, oh, I was only there because it's my brother or my cousin, or we went to high school together, or we dated, or I don't even know whatever people's reasons are, right? Depending on what it is, or I was with them for 32 years, and obviously you suck. I mean, there's all sorts of reasons that people leave, right? And sometimes that transition process is not always the easiest either. So
yep,
sometimes people get themselves into situations where they weren't as prepared maybe for a book, or they weren't as prepared for maybe a market that a book served, or they do things differently. We talked about that as well, as
yep,
far as like the expenses of what we reinvest back into our book. But I think we have to take into consideration, we have to know our numbers again. It comes back to knowing our numbers, right?
yep. And that's the thing is when we do evaluation and when we, engage in those conversations with owners, the more prepared you are for that conversation, the better it fares for you.
Yep.
Because if you, again, make assumptions, but you can't validate those assumptions or provide confidence for someone else to have, you know, the ability to make a good decision based on what's there,
Right.
it's actually becoming the norm. It pretty much already is the norm. You can acquire an agency that is all paper, right? They've got filing cabinets, right? They've got all the things that are outdated or antiquated.
Yep.
The agency that is able to validate their book of business or validate their activity or validate, their staffing, productivity levels, those types of things. And the easier you have those conversations, the easier it is to sell in most cases because people want to know what they're buying, right? It's really weird. It's like this really weird trend of like these mystery boxes. Have you seen those like subscription
Oh
boxes where
yeah, yeah,
you pay 20
absolutely.
bucks a
Like
month, 30
for
bucks a month, and then you
60,
get something in
yeah,
the
60
mail?
bucks a month, whatever you get some mystery
Yeah,
box worth blank, right?
it's like it's so exciting to see like, okay, where did I get this month? I mean, but would you want to invest in a company that was a mystery box?
Mm,
It's possible.
right.
There are ways to reduce your risk, but
But you
also
don't want you
this
don't want to not know what you're getting. I mean, you really I think a lot of people just look at the revenue and they think that they're going to get the revenue, but really what you're getting is all the headaches. You're getting all the servicing, you're getting all the policies, you're getting all the phone calls, you're getting all the emails, you're getting all the, the challenges that the clients have, right? Their attitudes, their joys, their trials, their triumphs, right? And I think that's really, really, really important to recognize.
exactly. So yeah, you said it. People get shiny revenue syndrome, but
Oh
really
yeah.
it's having good statements, it's having good data integrity, it's having the ability to know your own numbers, to be able to give someone else confidence to have a conversation with you.
Yep.
And also, even if you're not thinking about exiting or, or leaving or retiring, it's, kind of like we talked about with the profit and loss episode, it's the more you know your own numbers, the better you can manage what you have.
Mm-hmm.
And so it's not like it's not possible for somebody to, not grow an agency just because they don't have good statements. But having those things in place and having a system of good reporting and reconciliations helps you to manage what you have much, much easier.
Yeah.
And so, yes, having good profit and loss statements to know how much is coming in, how much is going out, having a good balance sheet as an owner to show you what the agency owns, what the agency owes, and then essentially what you have available to you as an owner allows you to be able to make those decisions easy, right? Helps you
Yeah.
sleep at night, helps
Well,
take
and your
that weight off your
equity. And
shoulders.
your equity is really important because I mean, if you do choose to walk away or choose to sell it or choose to whatever, you need to know at the end of the day what it's worth, what you're going to walk away with. Because I mean, that's part of the negotiation process, right? Like, I could sit back and say, oh, I got $20 million for my agency. But if I'm technically, in debt 19,995,000 and whatever, I don't even know, whatever, and I'm only gonna walk away with, $1,000, was that a profitable, 30 years in business?
Yep. Yep.
I mean,
And
that's challenging.
and you say that as an example, but I have seen cases like that where an agency owner had a really good agency, but because they made certain decisions to leverage themselves to a certain position and didn't use those resources to grow, in some cases actually could sell the agency for market value
Mm-hmm.
and walk away with nothing
Mm.
versus other agencies that, maintain their resources really well and were good stewards of what they had and continue to grow and invest in areas that drove growth and can sell and have other cash and assets available that essentially just kind of compound and add to what they're using,
Right.
And so again, that I think it goes back to what we even start with is, as an owner, setting your personal goals. What do you want to achieve? And then trying to set a plan and a roadmap to make those things happen in an efficient and predictable way. And so it's easy to get a loan, unfortunately. But again, if you don't use those resources well,
Right.
then it's going to be problematic for you in the short term and possibly the long term.
Yeah. 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 And it really can make it very challenging to get what you want out of it that really makes you feel strong and secure and that you've done a good job. I mean, I can see as a business owner, if I'm 60, 65, whatever, looking at retirement and I haven't leveraged my book correctly, that could be very emotionally challenging.
Yep. Yep. Exactly. So I think we mentioned this too, but like owners that get to a certain point make assumptions about what their agency's worth.
Yep.
And then when they try to retire or they try to exit and realize that it's not enough to retire on, but they haven't invested, to say, in a self-employed retirement plan or a 401k or, you know, bought real estate to where they can have rental income, right?
Right.
If you don't actually build a good system to achieve your goals, it can be, it's hard. It's hard.
Yeah.
And unfortunately, it's a reality for a lot of people. And
Hmm.
so, I mean, the saying is, people who fail to plan to fail,
Yep. I've heard that.
uh, which I think is a really harsh way to say it in some cases. But, the earlier you can prepare to, make certain decisions, the easier it is in the medium term and the long term, right? To prepare
Yeah.
for that marathon so you can actually have that, get to the finish line the way you want
Yep.
to.
Yep.
Um,
And you don't want to be crawling across the finish line exhausted and die at the finish line and have a heart attack, right? That's not what our goals are, you know?
yeah,
I mean, our
yeah,
goals are to be able to pass that finish line triumphantly, right? And to be able to feel good. And I mean, you're not going to feel that great after a marathon. I've run them. I get it. I've done it. I mean, you feel like you're dying in a lot of ways, but at the same point, there's so much of you that feels energized and excited because you accomplished a goal, right? And you're with this group of people that accomplished a goal, and you're in a different community now because you've accomplished a goal, right? And
mm,
that's what we want for people. We want people to cross the finish line in a very, very successful way, to where at the end of the day, whether or not they sell, whether or not they have somebody else who takes over, whether or not they have an office manager that manages it, and then they have an exit plan down the road for another avenue, we want people to be able to accomplish what they want, because there's not one way to do this. There's not one way to run a business. There's not one way to run an insurance agency. There's not one way to be able to manage our retirement. There's not one way to be able to manage exiting plan, right? A perpetuation plan or whatever.
yep,
So what we need to do though is we need to ask ourselves those hard questions, kind of back to the original podcast. Ask yourself those hard questions, define what you want, and then hire a professional like AgencyFocus or another, as somebody to help walk along your side to be able to help you achieve your goals. Because, I might not know insurance, but I don't know house alarms, right? Like, I don't know anything about security alarms on a house. I would not be able to come on in. I would not be able to wire it. I would not be able to set it up. I could probably install your app, but I probably couldn't do much more than that, right? I certainly couldn't teach you how to use your app, right? But the guy who comes and talks to us about our security system is that expert. I know how to be able to run insurance. I know how to run an insurance agency in a lot of ways, but I still have a business coach that helps me with hiring, that helps me with how to be able to manage my team most effectively. We need to make sure we also have that on the financial side rather than sticking our head in the sand, and making sure that we have the strong consultation, the strong conversations to help us get where we want to go. We spend so much time nurturing our teams, nurturing our clients, nurturing all these different aspects, but we don't necessarily spend as much time nurturing our goals financially and personally in this industry. And that's what this whole series has been about, is helping us to be able to level up in knowledge, in education, in knowing certain terms, being able to have kind of that baseline conversation before we even walk in and talk to an expert like yourself. And then from there, being able to say, okay, I'm ready. How can I be mentally, emotionally, spiritually, and financially ready to be able to make the changes that are going to get me where I need to go? But we have to walk through that door first of awareness. And we have to walk through that door of being able to make sure that we're ready to do the things that may be hard, but are going to get us where we want to go in the long run.
yep, exactly. And I'll admit, I'll be vulnerable for a second myself. I've got a sweet tooth, right?
Yep.
Or I'll tell people like I've got an insurance license. I passed with a 72 where you only need a 70, but like I've got my license, but also know like I'm not an expert in somebody's homeowner's forms, right? So
Right.
I call a good agent and I trust their process. You
Yep.
know, if not, if that agency gave me their P&L statements and asked for my financial guidance, like we could sit down and talk all day. But if it comes to my own policies, I know I'm not the expert. I'm going to hire somebody
Right.
that's better than me. And so, yeah, it's knowing, how you can actually get those things easily, well, efficient, and so that you can actually achieve the goals that you want to have.
Yeah.
And also, I mean, I mentioned like having a sweet tooth, right? So like delayed gratification is so hard for people,
Yeah.
right? Say finance is 80% behavior and 20% head knowledge. Um, Gosh darn it, like I love, a good piece of chocolate,
Yep.
but I know if I had it every single day, especially right now in Lent, right, it's not a good thing. uh,
Exactly.
but
Exactly.
you
And
mentioned,
we have to do what it takes to get where we want to go, kind of like that marathon conversation, right? I mean, if we don't put in the miles, we're not going to make that marathon. We're just
did,
not.
did you really run a marathon?
I did. I did.
Oh
I
my,
can show you my medals. Yeah.
that is so impressive.
Yeah, yeah. I don't, they're not in this room though, but yeah. No, they're not in this room, but they're in another room. I'll show you when we're done with the Zoom. Yeah, no, I ran a Cowtown Marathon, the Fort Worth Cowtown Marathon. But you talk about a marathon, you talk about training. I live in Dallas, okay, and so it's much flatter than Fort Worth. It's Dallas is, especially North Dallas, very very flat,
Yep.
okay. But then I was like, oh, Cowtown, it's February. It's a nice run through, you go through the stockyards, you go through lots of good old Texas history, right? I was all excited about it. Well, I didn't realize that Fort Worth is so much hillier. I never ran
Mm,
in Fort Worth, never
mm,
ran in Fort Worth. So I get there, and my husband, my first husband, my husband at the time, traveled a lot for work. So he ran as well, but he did not put in the amount of miles during the week. Like, he was really good about his long run on a Saturday, but going the runs during the week and then doing the speed training and the hill training and things like that, he did not do as much. So the combination of the two of us, it was really quite a funny story. So we go and we're running. He's 6'3". He's got longer legs than me. I'm only 5'2". And so, we're just running, we're doing our thing, right? So then about like mile 18, I'm stronger at that point, but I'm dying on these hills, right?
yep. Yep.
But he, on the other hand, he's hit that wall, because I think the farthest he had ever run was like 20 miles. And everybody's like, oh, if you run 20, you come out 26. I'm not going to say I disagree with that comment, but you're going to be bleeding and hate your life if you go to 20 and to be able to go to 26. I mean, to add 6 miles is a lot. I know
Yeah.
people say you can do it. I don't disagree that you can do it. I'm one of these people. I want to go like 29 to 30. So that with my 26, I want to be
Yeah.
one of those
Yeah.
people that
You're
cross
gonna.
the finish line going, yes. I don't want to
Mhm.
cross the finish line going, oh my gosh, I'm dying. I don't want to do that. So for me, that's why I like to be able to use that concept a
Yeah.
lot, is because I feel like there are lots of ways to cross that finish line. You can cross the finish line in an ambulance. You can cross that finish line running. You can cross that finish line crawling. You can cross that finish line walking. There's a point where, yes, you cross the finish line, and that is worth everything. But
Yeah.
on the other side of it, some of us want to be able to cross that finish line in a more triumphant way, to where we want to do another marathon, to where we're not in the hospital, we don't tear ligaments, and we don't like end up with horrible feet, or whatever, back problems, and I think that's really, really something that agency owners need to really consider, is how do we want to cross that finish line?
Yep. You nailed it. I think like a lot of times our ideal client are agencies that want to do some planning but just don't know how to start.
Yeah,
And so it's again, we start with what do you want to happen and how do we make it happen?
I love it.
It's almost that simple to ask. The hard
Yeah,
part is actually doing the work and the training and the
it is.
preparation. So
It is. Well, Colby, if people want to work with you, work with Agency Focus, how can they reach on out to you?
sure. So directly you could email me at Colby, Colby at agency-focus.com. I'm very active on LinkedIn. So if you want to connect there and send me a DM, that's great. Or our website has a contact page that's agency-focus.com. And you can find both Carrie and my calendar there to schedule a time to introduce yourself.
I love it. I love it. Colby, thank you so much for taking the time. We've had multiple amazing episodes, and just for you to be able to come really talk to us, dig deep into some of these topics and conversations that maybe a lot of us, like me, my undergrad's elementary education. I did not take business courses. I started my MBA and, did not finish it. So, it's one of those things where a lot of us don't necessarily have that knowledge. And we kind of talked about before how a lot of people come to agency ownership from being a producer, so we know our topic, but we don't know this. And so thank you so much for your generosity of your time, and for all you do to be able to help agency owners to be able to cross that finish line with that victory point in the mind. So I think that's wonderful.
Thank you. Can I make one more plug?
Absolutely. Go for it.
So you mentioned MBA. There is a program called the IAMBA, which is an
Okay.
acronym for Independent Agent MBA, put
Oh,
on by a lot of the big I state associations. It's a multi-week course that allows either agency owners or aspiring owners to go through kind of like a pseudo MBA program for insurance agency applications. And so Carrie, myself, and a few other people actually teach and facilitate some sessions that talk through financial aspects and goal setting. It's actually run by an organization called Goal Makers. And the
okay.
whole point is, how do you take that executive level decision making and apply that to your insurance agency? So I think that's a fantastic program. They have a cohort coming up soon, so find it IAMBA. Check your local Big I State Association website, and you can probably find it there.
I love it. I love it. I'm going to go look it up after this. Thank you so much, Colby. Everybody, this has been another awesome and amazing episode of the Power Women in Insurance podcast, where we help you to be able to level up with your career, with what it is that you're looking to be able to do, whether or not you're an agency owner, if you work in the corporate world, if you are in the agency side, or wherever you choose to be. The insurance industry is an amazing industry that fuels our economy and makes our world safer. The amount of just life that we have so many different ways throughout so many different things. So thank you so much for joining us. Check us out on Google Podcasts, Spotify, Apple iTunes, all the different places. And I will talk to you next week, Wednesday, when we have another amazing episode. My name is Teresa Kitchens, and I'll talk to you soon.